The gold mining sector is, I think, discounting what I see as 10 years of deterioration of the purchasing power of the US dollar. That's disguised because the US dollar is outperforming all the other currencies, which is to say that the US society, despite the fact it's very competitive, is losing the race to the bottom relative to the others. Now, I happen to believe that the business plan at place at Newmont is an intelligent plan. I also believe it's going to take a year and a half to play out. If you are willing to bet that they can implement the plan, you could invest now in anticipation of the successful resolution of that plan.
In this video, RickRule, president and CEO of Rule Investment Media, notes that the US dollar's relative strength hides its declining purchasing power and anticipates this shift could boost gold prices in dollar terms. With the global economic shift and downturn, the US dollar's valuation has taken a major hit. Per an article by Pragmatic Capitalism, the greenback has lost nearly 96.4% of its purchasing power since 1913. Rising inflation, economic downturns, and rising rates have caused the nation to experience a stark currency depreciation. From a technical perspective, Rick emphasizes how the gold mining industry rewards strong performers like Agnico Eagle while penalizing laggards like Newmont and Barrick. He predicts Newmont's acquisition of Newcrest could drive transformation through Tier 2 asset sales, debt reduction, and focus on Tier 1 assets. This strategy, though lowering production, could boost margins. Shares of Newmont Corporation, the world's largest gold producer, climbed up to 1% in pre-market trading Friday, supported by rising gold prices amid a weaker dollar and persistent geopolitical tensions, even as CLSA initiated coverage with a bearish outlook. According to Bloomberg, Newmont's stock experienced its steepest drop in over 2 years following its third-quarter earnings report. Despite posting its highest quarterly profit in 5 years at $4.6 billion, an 85% year-over-year increase, results fell short of analysts' expectations on earnings, revenue, and costs. Based on fundamentals, Rick mentions that large mines often exceed reserve estimates, with exploration extending their lifespans. Ultimately, he expressed confidence in Newmont's strategy if executed well and urged investors to monitor Newmont and Barrick's progress in aligning with their goals. Now we present the clips of RickRule's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I, in fact, am. The gold mining sector is, I think, discounting what I see as 10 years of deterioration of the purchasing power of the US dollar. That's disguised because the US dollar is outperforming all the other currencies, which is to say that the US society, despite the fact it's very competitive, is losing the race to the bottom relative to the others. While gold is very strong in currencies outside the US dollar, it's weak in the currency it's measured in. I think that'll change for reasons we can talk about later if you want to. But the gold mining industry is behaving rationally right now. They are rewarding companies that are performing, and they're penalizing companies that aren't. All-in sustaining costs stubbornly high at both Barrick and Newmont. Cash margins have been less buoyant than one would expect, given the increase in the selling price of the commodity that they produce. Margins have been expanding at places like Agnico Eagle, and they have consistently beat guidance. The consequence of that is that while Newmont is down, Agnico Eagle is up. Surprise, surprise. A company that performs does well. A company that doesn't perform does poorly. Now, I happen to believe that the business plan at place at Newmont is an intelligent plan. I also believe it's going to take a year and a half to play out. If you are willing to bet that they can implement the plan, you could invest now in anticipation of the successful resolution of that plan. To save your listeners a bunch of reading, the plan is that Newmont, after the Newcrest acquisition, will sell basically all of their Tier 2 assets. They operate too many mines now. Their management time and attention and their sustaining capital budget is split between too many competing mouths. The idea that they would take advantage of a very buoyant property market, which we're in right now, to sell the Tier 2 assets, use the cash to pay down their debt, and focus management love, time, and attention, and also sustaining capital on 5 or 6 assets that matter, is a really good plan, but they have to do it. If they are successful in doing that, of course, the gross ounces that they produce will fall. That will happen. But the margins will expand. The all-in sustaining capital costs will fall. The other thing that your listeners need to understand that is very difficult to understand is that the returns on capital employed in optimization are often double or triple the overall returns on capital employed in an operation. If a mine is put in production with an ROCE in the feasibility study of 20 or 25%, that's one thing. But after the mine is in production, when you're making smaller investments in optimization, retooling a mill, increasing the size of the haul trucks, increasing the size and efficiency of the shovels, return on capital employed in optimization can be 50%, 60%, 100%. Two, big mines are almost always put into production when there is enough reserve and resource to amortize the upfront capital expense. But those mines, in every case I'm aware of, deliver upside exploration surprises after near mine exploration commences, which is to say a mine with a 12-year mine life often produces for 18 years or 20 years. I look forward to Newmont benefiting from selling their Tier 2 deposits, improving their balance sheet, focusing their love, care, and attention on optimization, and expanding the mine lives in their Tier 1 operations. That plan will work if they implement it. It will be up to your listeners in terms of how their own portfolios do to monitor Newmont and Barrick's adherence to their plans.
In his assessment, RickRule criticizes the credit market, favoring short-term U.S. Treasuries due to high risks in long durations. He notes overpriced below investment-grade debt and investors chasing yield without understanding covenants. The United States debt situation has surged to alarming levels, putting it on track to outpace the economy. Specifically, the U.S. debt-to-GDP ratio now stands at 121%, the highest rate since 2021, according to data shared by the finance commentary platform the CoBC Letter on November 30th. This ratio is concerning because the last time the U.S. came close to this level was during World War II, when it peaked at 119%. However, Rick questions inflation metrics, estimating the dollar's purchasing power decline at 7.5%, far above official CPI figures. He argued that low yields on risky debt fail to offset inflation, making many credit investments unattractive. Let's get back to the interview.
I'm a credit guy. I think the worst piece of debt is better than the best piece of equity on any individual balance sheet. I don't like the direction of interest rates, and I don't like duration. I own, relative to most people, a lot of U.S. Treasuries, and I don't own a duration longer than 2 years. The interest rate curve between the short and the long is stupidly disproportionate in terms of risk. And the part of the credit market that I've specialized in most of my life, which is below investment grade, is insanely overpriced. People have chased yield without any understanding of the covenants and conditions on the bonds that have been issued. Wall Street has unleashed a torrent, trillions of dollars of debt that is junk debt in the truest sense of the word. I remember the junk debt market, the below investment debt market in Canadian oil and gas companies in 1988, 1989, 1990, 1991. You could buy bonds with a cover yield of 12% that was being earned, and you could buy those bonds, 4 or 5 year bonds, at 60% of par, which meant that you had an 18% running yield and a 25% yield to maturity. The bonds were covered by net present value in the first instance and by free cash flow in the other circumstance. You don't see that in the high yield market anymore. You don't see it in a market that I'm familiar with. I would point out something else to you, Jesse, is driven by a desperation for yield. And I think the yields are actually negative. People who buy bonds believe that a deterioration of the purchasing power of the US dollar is a function of the CPI, which is to say the bogey is 2.6%. I think the CPI understates the deterioration of the purchasing power of the US dollar substantially. When I look at the basket of goods and services that I buy, Jesse, I would suggest that the deterioration of purchasing power of the U.S. dollar is more like 7.5%. I'm not somebody who thinks that the U.S. dollar relative to other currencies is a bad currency. Our mutual friend Doug Casey says the U.S. dollar is the worst currency in the world except all the others. But I'll tell you that the CPI as an index is stupid. It doesn't include tax, doesn't include food or fuel. I mean, any index that doesn't include lunch is of no use to me. So for me, my bogey's 7.5%. The idea that I'm going into a 5-year junk term at 6.5%, which suggests that I'm losing 1% a year in purchasing power while taking real risk, is an insanity to me.
Shares of its peers: Barrick Gold Corporation, Agnico Eagle Mines Limited, Kinross Gold Corporate, and Harmony Gold Mining Company Limited were also up at least 1% in pre-market trading as spot gold climbed 0.7% to $2,659.98 per ounce. Concurrently, gold miners are facing rising labor and energy costs. Newmont reported a 10% increase in capital expenses due to expansion projects in Australia and Argentina. What steps should investors take to navigate this challenging economic environment and safeguard their portfolios? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.